Thank you so much for joining me on the podcast. I just wanted to start the episode with you running me through your personal background, actually, because I know you've had an amazing career.
Yeah, thank you, and good to see you, Eddie. So I joined Morgan Stanley just over a year ago, March of 22. Prior to that, I spent over 20 years focused exclusively on the ETF industry. So I was lucky enough and fortunate to have been one of the initial hires on the iShares project at then Barclays Global Investors. I helped build and lead that business. I was one of the initial 12 hires and was there for the first $250 billion at iShares, and it was just a great opportunity. I also co-led the Spider ETF business for a number of years here in Boston, where I am today, and worked closely with Jim Ross, who I know helped pioneer the ETF industry in the SPY way back in the early 90s. So that was a great experience. And then I guess I have a fascination with startups and big companies. And I was the initial hire at Fidelity, where I spent a combined 12 years building and leading their ETF initiative and served as president of Selectco, which oversaw over $80 billion in sector mutual funds and also built their initial ETF capabilities. So the opportunity to come to Morgan Stanley and help launch their ETF initiative was exciting. And post-acquisition of Eaton Vance over 3 years ago, all these great brands, certainly from Morgan Stanley, Eaton Vance, to Parametric, to Calvert on the ESG front, and really providing an ETF exposure on these multiple brands was a great opportunity.
Wow. Yeah, that's incredible.
It was, like I said, it was a great experience, and I've been a part of some of the biggest and most influential ETF launches at multiple firms. Lucky enough, of course.
Brilliant. And can you tell me a little bit more about the Morgan Stanley ETF platform? Because you just launched the platform with, I think, 6 new ETFs. So can you walk me through the initial thinking behind that product set and the launch of that platform?
Yeah, so we are in the initial phases of building out a broad global ETF platform. Dan Simkowitz, who runs Morgan Stanley Investment Management, released a memo shortly after I joined, and we began to build the ETF team. And he was very clear, our focus is multi-brand, multi-jurisdiction, and certainly multi-asset class. Equity fixed here in the U.S., down the road in Europe, and we're excited about that longer term. And certainly across those brands I mentioned earlier. If you look post-transaction of Eaton Vance, you've got a great alpha engine in Morgan Stanley Investment Management, certainly Eaton Vance on the equity and fixed side. You've got a customization engine on the SMA front with Parametric, which is well known here in the U.S. And then Calvert, 40 years of history and a pioneer in the ESG space. So you bring all these great brands, both here in the U.S. and overseas. And effectively, our mission is not to launch ETFs versus mutual funds, because we think it's providing additional choice. We think ETFs, alongside mutual funds, alongside SMAs, and even a $200 billion alternatives business globally, really help provide choice for clients. So if you work backwards from the client, Eddie, we started looking at the data, and it was clear we need the ETF wrapper to complement, all these great investment capabilities.
And what types of ETFs are you focused on predominantly, and what's to come in the future?
Yeah, our first set certainly was Calvert. As I mentioned, Calvert's a pioneer in ESG investing. They've been doing it over 40 years, dating back to the apartheid era in the 80s. They launched one of the industry's first mutual funds. And it was clear there was demand from clients, there was demand from our distribution teams that if we bring ETFs, ESG ETFs and Calvert would make a great first step, certainly in the U.S. So we launched a large cap, a mid cap, an international, and a thematic diversity, equity, and inclusion ETF. Those 4 are passive. And then we launched 2 fully transparent active ETFs from Calvert. The Calvert Select, which is primarily large domestic exposures in terms of the constituents, and then the Calvert Ultra Short, which, at one point 2 weeks ago had, almost a 6% yield and is traded quite well out of the gate. So 2 active, 4 passive. I think longer term, your second part to your question, if you look around the corner, we're primarily focused on active investment management on a go-forward basis. We'll certainly continue to look at passive and systematic exposures. But when you look at our heritage and what we do within Morgan Stanley Investment Management and the 4 brands I mentioned, it is really an active managed organization.
Yeah, that's brilliant. I just want to zoom out a second because our audience is predominantly retail investors. And I just want you as the absolute expert to zoom out and say, how big is this ETF market and why are they so attractive as an investment product?
Yeah, well, let me give other projections in the industry. These aren't mine. Brown Brothers just released a survey. They had over 350 investors globally. They estimate the global ETF market by 2033 to be 30 trillion globally. Pretty aggressive number from Brown Brothers. When we look at Cerulli, they estimate the U.S. ETF market by the end of this decade to be at about 15 trillion. So again, those are third-party predictions. But what we know is ETFs over the past decade have grown at a 15%, 16% actually compounded annual growth rate. And as I said earlier, it's not an either or, it's an and. It's mutual funds, SMAs alongside ETFs. But we know certainly in the U.S., the more advisory-based, the financial advisor, or the more fee-based, the more likely they are to wrap ETFs alongside other vehicles. So we think those projections, while aggressive and certainly interesting, is a trend that we'll continue to see in the market. We hear that loud and clear, from our clients.
Yeah, definitely. But in terms of the actual percentage of overall kind of, let's say, fixed income markets or equity markets, the ETF market is actually quite small, isn't it?
It is, and it's growing. But when you look, here in the U.S., it's about a $7 trillion market at the end of the first quarter, 23. When you look at, the traditional mutual fund market, that's 17 or 18 trillion. So no question about it, smaller. But when you look at the velocity of growth, ETFs have seen 46 consecutive months of net inflows through a very difficult market in full year 22. I think the other trend that's noteworthy, and there's some reasons for this, and we can spend some time on it, Eddie, is active management. And that's really where we're centered in the Morgan Stanley ETF platform. In full year 22, and these are just U.S. statistics, I know your audience is global, but for the U.S. market, about 5% of the $7 trillion market sits in active management, mostly fully transparent. Over half of that in the fixed income category. Yet it was almost 15% of the flows in full year 22. If we look in the first quarter of 23, and this is real-time data, the flow is somewhere between 30 and 35% of all ETF flows in the U.S. in the first quarter of 23 have gone into active ETFs. And what's interesting about that, you mentioned fixed income, Eddie, is a lot of those flows are going to active, transparent fixed income on the shorter end of, on the duration front. So I think active is an accelerant. And, I go back to the Brown Brothers survey that just came out, early in the first quarter of 23. It was interesting. 92% of the respondents to their survey actually bought an active ETF in the last 12 months. That's very different than even 5 years ago here in the U.S. Active ETFs are relatively new. I think the other trend or the other change that's really helping fuel this trend is the regulatory shift in the U.S. In 2019, the SEC passed what's known as Rule 6C11, or the ETF rule. And that really enabled traditional active managers to get to market faster. And so we've seen a lot of other organizations that look similar to Morgan Stanley Investment Management enter the space, and many of them are centered on traditional, transparent active management.
Yeah, that's so interesting. How surprised were you looking at last year, because we had such a volatile year, right? The 60-40 portfolio had its worst year since 1930. I think there was a huge amount of volatility, yet investors were still, really seeking out particularly fixed income ETFs. How did the market volatility of last year play into ETF flows and the market conditions?
Yeah, having been in the space over 23 years, I've looked at, you go back to the credit crisis, you go back to the pandemic, you go to a really difficult market in full year 22. Those three periods all saw ETFs actually used as price discovery vehicles. We saw it during the pandemic. We saw it in '08. And in some ways, these difficult markets really help validate the on-exchange nature of these exposures. And certainly we saw investors voted certainly on the shorter duration front. They also voted with downside protection ETFs in the U.S. in full year 22. And we saw a lot of inflows in whether it's buffer ETFs or downside protection ETFs. And so again, that's really where I've seen innovation over the last 2 decades in the ETF space, is in these difficult markets. And so I think 22 was no different. But what's noteworthy is the global ETF market in full year 22, one of the worst markets in the last decade, saw over 840 billion in net inflows, number 2 all time to obviously the year before. So I think that's really noteworthy, that investors are using ETFs both in up markets and certainly in down markets as well.
Yeah, we can echo that kind of sentiment from our retail investor survey that we do. And actually at the start, even in Q4 of last year, they were looking to ETFs as almost a safe haven, the SPY ETF. And obviously we can differentiate between the ETFs, but they were moving out of, let's say, speculative kind of names and actually seeking safety in those ETFs. So that was very, very interesting. In terms of this year, we've obviously seen huge fixed income volatility. We've seen a regional banking crisis, if it's fair to say that. Definitely, I think it's fair to say a regional banking crisis. We obviously have a very attractive yields on offer on the short end of the curve. What trends have you seen in terms of ETF flows and demands through this year, maybe the first quarter?
Again, I go back to active. Well over 30% of the net flows in the U.S. came into active managed strategies, and that's data from Vetify. I also saw some data from Bloomberg. So anywhere between 30 and 35% of the category, so active flows. The majority of that was in shorter duration fixed income and active transparent. And so I think that's one noteworthy trend. I do think fixed income is really also noteworthy. I mentioned active, but we know investors are using various parts of the curve on the fixed income front, and that is a trend. We expect will continue over time.
Yeah, interesting. Transitioning maybe to a certain part or different type of ETF, which are factor-based ETFs. For our audience, could you maybe run through some factors, what that actually means, and what factor-based ETFs that are either seeing flows so far this year, or you would expect to attract some flows, because obviously there's a huge debate, for example, around growth versus value, for example. So could you shed some light on factor ETFs?
Yeah, and again, I'm probably not the best person, Eddie, to talk about the future and what the market's going to do. I think my role is really to create a vehicle and the exposure. But whether it's growth, value, momentum, these are three of the factors that investors look to. I think the bottom line though is, with the broad ETF universe available, investors can express a view. They can they can obviously over and underweight a portfolio. We certainly saw growth run hard, through early 22. Again, it's not, my view to try and predict where the market's going to go, but we certainly see it in the flow data, that investors have moved away, in the past, 12 months from, the growth part of the market. And we do hear more investors looking at things they can control, like dividends. We certainly know when you look at the data, there's investors expressing a view in value-based ETFs. So one thing I would say specifically about the benefits of ETFs is this is more of a general comment, Eddie. It's not specific to your factor question, but advisors have told us clearly they want choice and they want to have the ability to control the outcome for their clients. And as I mentioned, here in the U.S., more advisors are wrapping ETFs, and they're also controlling things like capital gain distributions and taxes and lower fees. I mean, those are things the advisor can control, right? The fee to the end client, also the tax experience. And we've heard loud and clear that, the tax efficiency afforded, to investors through an ETF wrapper, because it's in kind, is much more advantageous than some other vehicles out there. Certainly SMAs, are much more tax efficient, but we continue to hear, tax efficient and, controlling the pricing is important for FAs.
Absolutely. And you've launched ETFs in the US. Europe's to come in 2024. So what can you tell us about your European expansion in the future? Why is it an attractive market for Morgan Stanley?
Look, I think it's an attractive market for a number of reasons that I just went through in the US, right? Tax efficient, tradable on exchange. You can express a view in a very cost efficient wrapper. All the benefits, obviously, in Europe are the same. I think the one unique trend in Europe is ESG specifically. 65% of all flows in full year 22 in Europe were in ESG. 65% of the ETF flows were in ESG. 20% of the ETF market, or almost 20% of the entire European ETF market, is in ESG exposures. And so we think that's a unique area. Again, very early. We're obviously primarily focused in full year 23 on our U.S. launch and, from Calvert and, potentially other active ETFs that we would like to launch here in the U.S. But 24 and beyond, we're certainly looking at Europe. But I think ESG, really jumps out given, investors are really voting, with their, with their dollars or their euros, I should say.
Yeah, with their euros. Yeah, no, ESG is definitely a hot topic and will continue to be a hot topic, obviously, as we transition to 2030 and 2050. In terms of looking forward now, so you were there right at the start, to kind of 2008, 2009 with iShares or there or thereabouts. If we were to look forward now for the next 5, 10, maybe 20 years, where is the ETF market and ETF product going? What innovations do you see on the horizon? Obviously we've said the market's going to grow tremendously. What are your kind of key things that you're excited about or you think we're going to see in the next kind of couple of years?
Yeah, let me go kind of past, present, and future to answer that question. If you go way back, I was on the team that launched AGG, the first fixed income ETF in the market, at iShares, and that was cutting edge. At the time, this equity actually owned underlying bonds, and who would have thought? That was a cutting edge innovation, dating back, almost 2 decades. If we look at GLD at State Street Global Advisors, I saw that ETF grow from about $1 billion to over $75 billion, during the credit crisis, right? And this idea that you had physically backed metal in a grantor trust structure, that was very innovative. The idea that you could launch a series of factor or smart beta, as you asked about earlier, that was cutting edge. So I can't predict what the future holds, what's the next. But I will say active management has been talked about, for more than a decade. And starting in 2019, we began to see it adopted. And so that's the exciting part, is managers like Capital Group entering the market. They've done a very nice job in bringing innovation to the market. Organizations like JP Morgan surpassing $100 billion in assets. Almost half their book is actively managed, right? So I think the exciting part is you've got large global, at the core, active managers coming to market, and they're committed to the ETF market, just like Morgan Stanley Investment Management and all the brands we talked about. I think that's the exciting part. So rather than, try and put my finger on, what's next, even, digital investing, right? That's ebbed and flowed, and I'm not predicting that it's going to continue to grow. But those are areas we know, investors have looked at. So that, to me, the exciting part isn't, exactly which product. It's actually who is developing these products and